This is my SPY options trade log. I ran this as a live test. 10 spreads over the past year, 361% return on that capital. But I almost blew the whole thing up before it even started. And understanding that mistake is actually what made this possible.
Which is exactly what happened in August. Popular carry trade bets include US tech stocks, but right as this was all unfolding, a string of disappointing earnings from those companies sent their shares tumbling. The yen triggered waves of volatility in global markets.
The Dow dropped 1,000 points before lunch, and my calls went down 70% in a few hours. I was net long the S&P. And at any given point, that is a directional momentum bet. I knew that. I just convinced myself it didn't matter because I had a short call above it. It mattered. I've been running a long-short options portfolio for years. The concept is simple. You don't bet on one direction or macro outcome. You put on exposure on the upside and the downside at the same time. Markets go up, one side wins. Markets drops, the other covers it. You don't have to predict anything. The math works out in your favor if you structure it correctly. Morgan Stanley built this framework in the 1980s with spread trades. Goldman Sachs refined it in the early 2000s with long-short models. So after that, I went back to what I know actually works. You stop caring about direction entirely, but here's the layer most retail traders never find. Underneath the price of the S&P, there's a mechanical force that most people don't know exists.
Wags, ever get tired of working for a living?
Every damn day. But I've got a nasty addiction called money, so I do what I do. You?
No, never. Until today. You know, they call us traders gamblers. The world economy is just one big casino, fueled by a giant debt bubble and computer-driven derivatives. There's only one thing better than being a gambler in a casino.
That's being the house.
That is right. There's a systemized machine out there, sucking capital from localities and injecting it into the global markets where it can be used to speculate and manipulate. And if something goes wrong, there are bailouts and bail-ins, federal aid and easing, where the government doesn't hunt you down, but instead gives you a nice soft net to land it.
That's your answer to the fireside chat. You want to become a bank.
I want to become a bank
In order to rob it?
in order that I don't have to. To sleep like they do. And to die in my own fucking bed.
Goldman Sachs and Bank of America publish gamma exposure research that I cover weekly. It tells you exactly how big bank dealers are positioned at every major S&P level. When gamma goes deeply negative, like it was negative 2.7 billion earlier this year, first percentile since 2014, dealers are mechanically forced to sell into weakness and buy into strength simultaneously. They have no choice. It's their hedging requirement with a zero selection portfolio. That's what caused the waterfall drop to 64.75 during the tariff panic. And that's what caused the 2.9% single day melt up recently. Both of these moves are mechanical, not driven by headlines, by dealer positioning. Bank of America called it explicitly. They flagged what they called right tail fears. The market's biggest risk had shifted from crashing to missing the rip. That's exactly what played out. Before I keep going, I want to give you the tool I built to track this. I mapped Goldman Sachs and Bank of America's gamma research directly on your TradingView chart. 3 zones. Automatic alerts when price crosses any boundary on the daily. Free. Works on a free trading account. Link is in the description. This is what I check before every spread that I place. Without it, you're reading price. With it, you're reading what's driving the price. Let me show you how this plays out in real time. A few weeks ago, I was tracking the Iran situation, but I was watching 2 other things. First, my proprietary market breadth indicator, how many individual stocks are actually participating in market moves. Second, I overlaid the NASDAQ 2025 price action against 2026. Almost identical pattern. Same early year drop, same setup from a mean reversion. The 2026 version just moved faster. The Gamma backdrop confirmed it. Negative 2.7 billion in dealer Gamma meant dealers were mechanically forced to buy into every uptick. The market has structural support, regardless of what the headline said. Bank of America was already flagging right tail fears. So I put on a diagonal spread. Long July 690 calls, short the June 710 calls for a credit to offset the costs. I went long the July 630 puts and short the June 590 puts on the other side. Both directions covered defined risk on every leg. My breadth indicator this past Friday hit what I'd call peak reading. Stock participation approaching the top of the historical channel around 1,200 new yearly highs. That's the signal the move is getting stretched. So I placed the SPY 690 calls, put them on at 855 net costs, and closed roughly at 3,997 per contract. That's a 255% return on the calls. The put diagonal closed at a small loss. Net on the whole trade, very solid. I called the bottom, I called the top. Not because I predicted anything, because I read the mechanics. Here's what the full year looks like. Now this is assuming we're working on one contract per leg. 10 spreads, 13,804 in gross wins, 6,584 in losses. That's $7,220 net. That's a 361% return on capital. Every single position had defined risk before I placed the order. I knew exactly what I could lose before any money moved. That's the August 5th lesson applied in practice. Every trade, no exceptions, profit factor of 2.1, meaning for every dollar I lost, I made 2 back. I went 11 and 9 and returned 361%, because when I won more than I lost. That's the asymmetry. You don't need to be right most of the time. You need the math set up correctly. But here's what I haven't shown you yet. Everything I just walked you through is the execution layer. The spreads, the gamma zones, the trade structure. There's a decision layer underneath all of it that I haven't covered. How I actually find the ideas before they show up in price. How I called the Adobe short before the software short went mainstream in the news. How macro shifts translate into specific trades month before the market catches up. That's a completely different skill set. If you want to watch this video without watching the next one, you have half the picture. The execution is what I showed you. The decision is what next. Link is right here.